Hello, I'm Janna Fertsman with Remax Nova. I'm here today discussing mortgage pre-approval with Igor Geshelin with Premier Mortgages. Welcome, Igor.
Thank you for having me. Happy to be here.
We having right now a series of different clips, videos discussing mortgage, anything relating to mortgage, how it works, how to get pre-approval with different banks. Igor is a wealth of knowledge, has lots of experience. Igor, today we'll talk about mortgage pre-approval in more detail. What do people, when people come to you, what are you looking for?
So it's a great question. It's good to consider what is a pre-approval, which is a review of someone's ability to get a mortgage, a calculation of how much mortgage, both from the perspective of how much will a bank provide to someone, but also how much is that person actually comfortable taking on. Just because a bank might give someone, $1 million
Yes.
doesn't mean that that's what that person actually wants to borrow. So it's a review of your ability to get a mortgage, a calculation of how much, and it's important, which I think is part of your question, it is important that it's actually validated with documents.
Yes.
With reviewing a pre-approval, it really comes down to three things. It comes down to somebody's income and type of employment. So it's not just about how much someone earns. Things like, are you employed or self-employed? Are you part-time or full-time? Are you salary or hourly? Are you on a contract? This is what I mean by type of employment. The way in which you earn your income matters very much. It can actually matter more than the actual income amount. So that's part one. Part two is your down payment, simply in that there's a requirement to have a down payment, and then there are different amounts and benchmarks of down payment that are valuable and important. And the third piece is credit / debt or monthly payments. With credit, people get really focused on their credit score and how high it is,
Yes.
which is a good thing to focus on. But credit is actually very black and white. It's either good enough to get a mortgage, or sometimes, unfortunately, it might not be, and then that's something to improve. But how high your score is after a certain point actually doesn't really matter anymore. It's a good thing to try to increase, but there's a point where it's just good enough, and that's good enough.
And what is the good enough? What are the numbers?
So in general, a credit score of 700 and up would be a target. It's technically out of 900, but someone with an 850 score, which is really amazing,
Yes.
there's nothing they can get that someone with a 750 score cannot get. So there's a point where after 700, 720, it's just excellent, and that's where you want to be. Even if it's not there, it doesn't mean you can't have a mortgage, but in a perfect world, that would be ideal. But even something in the mid or high 600s could still be perfectly workable.
Yes. Igor, so when you're collecting documents to get the mortgage pre-approval, what are you looking for?
So that depends a lot on the person's income type. So for example, if someone is salaried and they have a salary job, we would typically need a pay stub and T4s. Sometimes a letter from the employer is needed, not always, but sometimes. If someone is self-employed, the requirements are a bit greater. There's more paperwork needed. Typically, banks are looking for the last 2 years of tax returns, and sometimes we can even get into more than that if someone's situation is a little bit more complex, like bank statements or business financials, but generally tax returns. That confirms the income. For confirmation of down payment, we typically require anywhere from 30 to 90 days of history of the funds for the down payment. So that's a requirement. And beyond that, it depends on each person. So for example, if somebody owns other properties, maybe they own a rental property, there would be some documents to confirm, the lease agreement, the mortgage statement. If someone is newer to Canada, we may need a copy of their work permit or their permanent residency card.
Yes.
So there's things that are individual to any person, but typically confirmation of income, confirmation of down payment are the key documents that are needed. And the reason the documents are important is that sometimes what can happen is someone gets a pre-approval and the person they did it with says, how much do you make? And they say, 100,000. And they say, okay, great. Based on that, you're pre-approved for this much mortgage. Then they go and buy a house. And then the documents are requested of them, only then, which is not the way it should be done. And then it turns out that their salary is actually 80,000,
Yes.
and they have the potential to make 100 with bonuses. So they didn't lie, they didn't mislead anyone. They answered the question truthfully.
Yes.
But now a bank is going to look at it very differently.
Right.
And the pre-approval they thought they had may not actually be accurate anymore.
Yes.
So that's why upfront document review is really crucial.
Yes. And Igor, if someone they came from another country, they have a house or an apartment, condo in another country, and they currently renting it out, would you be able to use that as an income?
It depends. It becomes very case by case. That can be difficult to verify depending on the country, because there may not be a tax return in that country that a Canadian bank would recognize. So that can be difficult to account for in a mortgage application.
Very good. Yes. So
Yeah.
sometimes, people asking me about those questions. Also, Igor, if someone is working not for Canadian company, but maybe they moved here, they're working from home, but their company that they're working for is overseas.
Yeah.
Do you count that income?
That again becomes very difficult, unfortunately. Banks may consider that as a non-resident type of income, which is a bit confusing because the person is actually a resident physically, but their income is a non-resident income source. And a lot of banks actually have a problem with that, and it makes the process complicated. It does depend on how that person claims the income. We have had clients in this situation who then claim that income essentially as self-employed income. So they provide a service, consulting or IT or whatever it might be, and they may only have one client, which is really usually their previous employer in the country that they moved from. But if the income is reported as self-employed income here, then we can work with that. But if it's not reported in Canada at all, and it's reported in their home country, then it does become quite difficult.
Yes. So it is sometimes self-employed people, they have cash income. Maybe taxi drivers, maybe someone who's a hairdresser or the other self-employed. How do you work with those people? Are you only looking at tax returns, or can you look at other sources of income? And how do banks look at that?
For sure. So there's essentially three levels of options available to someone who's self-employed. The most traditional one is, which some banks only have this option. The most traditional one is 2 years of tax returns. What you showed there is all they will consider. That's it. End of story. So for some banks, that's it. There is another program for someone who's putting down at least 10% called the stated income program.
Okay.
Where we can state a higher income than what the tax return shows, but we have to be able to justify it. So this is where we might get into business bank statements, financial statements, things like that. It's not really meant for cash income, but a case where someone may have income within their company that maybe they didn't personally claim. It's very case by case, but this program exists. And then there's another option altogether if someone puts down 20% or more. And that is to look at, again, a stated income type of program with what's called an alternative lender or an Alt-A lender or a B lender, sometimes people call them. And these are banks that are a lot more flexible with how they consider income. They will look at, again, 12 months of business bank statements. They don't actually really consider tax returns at all. They'll look at bank statements, invoices, contracts, whatever is applicable for somebody's specific business, and they'll try to wrap their head around what someone's real income is within that. So if there's, cash deposits, if we can show where they came from, again, with invoices or something like this, they can work with that. These banks do typically have a bit of a higher interest rate, so there is a trade-off to working with them, and you need a 20% down payment. But the rate difference is not that much, honestly. And it can be a good solution as an alternative if someone needs that.
So if someone, like someone's watching us and they go and say to TD Bank or they go into Bank of Montreal, so how would the Bank of Montreal look at that client, and how would you, as a mortgage broker who works with many other lenders, would you talk a little bit about that? Because probably people looking into, they think all mortgage brokers are the same, all banks are the same, and all institutions, you know?
Right. Yeah, so they're definitely not. There's definitely a variance between the banks as to how they all account for certain things. And it's not to say that any one bank is good or bad or better than the other.
Yes.
They just have different specializations. So for example, some banks have we call it an appetite. So they have a good appetite for looking at an application for someone who has rental properties. Whereas there could be another bank who does not. They're not very favorable for someone who has a rental property. Same for somebody who's on a work permit. There are some banks who just don't have a mortgage product for someone on a work permit, whereas many do. And so self-employed is the same thing. So some banks only have a very kind of black and white program for someone who's self-employed, which is show me your last 2 tax returns, and if that doesn't work, then that's the end of the road. But then other banks have different products and programs that are much more flexible. So there's no one bank that's good or bad, just some are good or not so good at specific things or specific situations. And the job of a broker is to know those nuances and help navigate that for clients and help find the right solution with the right lender.
Right, because the goal is to purchase a home. Maybe it's a first home, maybe it's an income property.
That's right.
The goal is to get a mortgage, to get a lender to look at this client.
Exactly.
Through the eyes that you would be able to help them to get. That's right.
The banks are tools, and there's a goal, and so there's a group of tools available, and some you wouldn't cut a piece of wood with a hammer. You would use a saw, right? Yes. And so you pick the right tool for the right job, and so having access to these different banks helps us accomplish goals for clients that way.
Going with these questions, sometimes people think that the interest rate that's most important in buying a home or getting a mortgage. What would you tell us about what's most important? Does interest rate always important, or there is other nuances?
I think the best deal is most important. And I think people in their mind often equate the lowest interest rate to the best deal. And sometimes that's true. If someone's application is very simple and they can get a mortgage from every single bank and everything is nice and easy, then the lowest rate becomes a pretty big factor.
Yes.
But even that, there are other differences between banks, like for example, the ability to prepay. Yes. So if someone's goal is to pay off the mortgage faster, every bank to some degree allows you to do this, but by how much and when differs from one bank to another. Now, some people might not care about that, and that's okay. But for someone, that could be the difference why they pick one bank over another.
Igor, I think this we will leave for another another video, just talking about how quickly you can pay off your mortgage and what are the products there.
It's more so that the interest rate is a piece of the puzzle.
Yes.
It is an important piece of the puzzle. It's a really big piece of the puzzle, but it's not the only one. Same when someone asks you, Janna, find me a house, they don't say, find me the cheapest possible house. They'll say, I don't want to pay more than a certain amount, but I have these other criteria. I need 3 bedrooms, I need this school zone. They don't just say, what's the cheapest home in Halifax that I can possibly buy? So same for the interest rate. Of course we want the lowest rate, always. But as long as we're also getting the right package in every other way.
And the goal. What is your goal?
And the goal. And so there can be situations where someone might choose a slightly higher rate because that mortgage comes with other features or factors that are important to them.
Or simply just getting a mortgage.
Well, that too. Sometimes that can simply be it too. But it can just be a choice as well. You look at the big picture and with your mortgage professional's help, figure out which option is best for you. Rate is a key part. It's not the only part.
Yes. So, Igor, also, how much do you need to have for so 5% for down payment. That's the lowest you could go for. And also, what other expenses with the house purchase?
Yeah, so one clarification is that the rules have changed over the years, and a home that is more than 500,000 in purchase price actually it requires more than 5% of a down payment now. It used to be just 5%.
Right.
It's now 5% of 500,000 plus 10% of the rest
Additional.
of the additional amount above 500. So that's a quick clarification. But as far as other costs, the biggest one, especially if you're buying in Halifax regional municipality and really most parts of Nova Scotia, is a municipal deed transfer tax or a land transfer tax, and it's 1.5% of the price of the home. Unfortunately, it's not cheap. The government needs their piece of everything.
Yes.
And so 1.5% of the price of the home is the biggest additional cost. Additionally, you will have expenses for things like legal fees, home inspections, tax adjustments, which individually, it's $500, it's $1,000, but it adds up pretty quickly. So we usually suggest another 1% of the price of the home is a safe estimate. It is just an estimate, but ballpark, it's safe. So in summary, 2.5%, so 1.5 tax,
For the taxes.
1% miscellaneous above your down payment would be a very safe buffer to work with.
Yes. Yeah. And do you have anything else to add? What do you usually feel that people don't know when they come into you, and they don't know? There is a surprise. Any surprises that you think of?
I think just people's general understanding of the process and the why. So a big piece that we focus on is not giving someone a result, just to say, oh, you can have 500,000.
Igor, there is a fly. Maybe you can do it like Obama did.
I think what people don't know is the why behind their pre-approval, and that's a big thing we focus on to explain it. People sometimes provide their information to someone, they get a result, they're told you can have 500,000, good luck.
Yes.
And they have no idea how or why or what they could do to try to improve on that amount if they want to. So it's not that there's any one specific thing. I think it's the whole thing that people don't really understand why it works or how it works. And so that's what we really focus on, is not just giving someone a number, but making it very transparent and very educational so that they understand what's going on as they really make the biggest financial decision that they usually will make in their life.
Thank you so much, Igor.
Thanks for having me.
It was very informative. And if you have any questions, please write down your questions under this video, and Igor and I will be able to get in touch with you and answer them.